recorded at about $1.5 billion, and Alibaba is recorded at $3 billion, but there is this internal logic in accounting that only they understand, which tells you it's okay. That's what they invested to get these holdings, so that's what we're going to show. And then, of course, accountants like to talk about intangible assets. I've never understood this fixation with tangible versus intangible, to be quite honest. But we can see the rationale for intangible assets, right? So if I walked up to you and said, what's Coca-Cola's most valuable intangible asset? The answer is not the syrup, but the brand name. Who cares what's in the syrup? After all, Coca-Cola tastes different in different countries. When I ask you what's Apple's intangible asset, you can say the coolness factor, the styling, the operating system. So we can think of bunches of assets that are intangible assets. But if you look at an accounting balance sheet, what's the most common intangible asset you see on the balance sheet? 95% of all accounting intangible assets is one item, which is goodwill, which I think is the most misnamed and disastrous accounting item ever created. To show you how meaningless goodwill is, think of what a company has to do for goodwill to manifest itself on a balance sheet. What does a company have to do? Not even an asset. It has to acquire another company, right? So if you're the greatest company on the face of the earth and you've grown entirely with internal investment, there will be no goodwill on your balance sheet. So take a look at Apple. There's very little goodwill because it's never done big acquisitions. The minute you do an acquisition, goodwill pops up. And what does it measure? Oh, thank you for saying book value. I was afraid that the accountant had brainwashed you to say things like fair value or things like that. It's really the difference between accounting book value and what you pay for the asset. So as an example, if you have a company with $4 billion in book value and I pay $10 billion, the accountant has a $6 billion problem to explain away, right? Because until yesterday, what was he saying? The company's worth $4 billion, it's worth $4 billion. Oh my God, it's worth $10 billion. So what does he do? He takes the $6 billion and he puts it in the balance sheet. And he does it for a very simple reason. If you did not put this item on the balance sheet, your balance sheet would not balance. Goodwill is a plug variable. But you know the problem with goodwill? It sounds good. And when something sounds good, people feel the urge to pay for it. And then they feel this follow-up urge to email me to ask me how much they should pay for it. This is a classic email question I get. I'm buying this company's $5 billion in goodwill. How much should I pay for the goodwill? To which my response is, it's a plug variable. There's nothing behind it. What the heck are you doing? Thinking about paying for something that's a plug variable. But that's an accounting asset. On the liability side, of course, you have current liabilities, you're short. And there again, the rules vary all over the place. But then let's get to shareholders' equity. You look at any accounting balance sheet, right there, right? What goes in shareholders' equity? In an accounting balance sheet. So if I look at Coca-Cola and I see shareholders' equity of a certain amount, what's in there? Their original IPO, when was that? 100 years ago, plus every retained earnings since. It's the ultimate backward-looking number. So what? So here's the first thing I want to draw. If you look at accounting balance sheets, they're backward-looking. They record the past, and they're rule-driven. Accountants love to write rules. You know how you can tell? Look at the rule number. I remember the first time somebody showed me FAS 157. I didn't even read the rule. I said, FAS 157? There are 156 other rules that I haven't even read yet. But it shows you how accountants think like, like teachers with 6-year-olds. Let me write a rule. Don't think about it. Let me write another rule. So accounting is rule. So the first thing I tell people in my corporate finance class is I want you to get out of the accounting mindset. Stop looking backwards, start looking forward. Stop thinking about rules, start thinking about principles. So I'm going to give you a contrasting view of a balance sheet. I call this a financial balance sheet. At one level, it's far simpler than an accounting balance sheet. At another level, it's far more complicated. I know you can't read anything there, but don't worry. I'll put this up online. You can download the whole thing and play with it, change it, use it as your own. I don't care. Right? There are only 2 items on each side. At that level, it's simpler. So let's look at the 2 items of the assets out of the balance sheet. If I look at a company, I break assets down into assets assets. Let me explain what assets in place are. These are investments you've already made as a company and the value that I attach. So I'm going to play a little game. We're going to have two companies. You guys are going to be Microsoft and you guys are going to be Flipkart. Ready? They say, yeah, I've got the fun side. Sorry, somebody had to be on the fun side, so you be on the fun side. Let's talk about assets in place. So I'm going to ask Microsoft. What are the assets in place? What are the investments that Microsoft has already made that drive its value? There are only two investments that Microsoft has made in its lifetime that create value. One is Windows, the other is Office. Everything else they've done is more liability than asset. For 20 years, we've been watching a string of Microsoft write-offs, right? It's almost like you can call this a clockwork. Right? It's only a question of time before they write off the service. The question is whether they write it off in 2016 or 2018. But just get it done. Why do we go through this charade of this might actually work, this might actually work? It's not going to work. But those two assets in place, Windows and Office, are huge cash cows. They're probably worth about $250 billion. Just cash that you're going to get off. Microsoft assets in place at $250 billion. What about growth assets? Well, given what I just described about every attempt to create growth in the last 20 years, you know what the market is attaching as a value to growth assets at Microsoft? Minus $20 billion. So how can it be negative? If you keep throwing $2 billion and writing it off 2 years later, and throwing another $2 billion and writing it off 2 years later, and you make this a pattern, you're either insane, or I have to start building that into your valuation as an expectation. This is the way the company operates. So Microsoft's value of $230 billion, 110% of it comes from assets in place, minus 10% from growth assets. Let's take Flipkart. What's the value of assets in place at Flipkart? What assets in place? There's really nothing much to build off. It's not like you have significant assets, like huge earnings or huge revenues. So the assets in place are worth very little. Now you and I can disagree about how much Flipkart is worth, but whatever the disagreement is, let's face the fact, the bulk of Flipkart's value comes from expectations for the future, perceptions. So 90, 95, maybe 100% of Flipkart's value comes from growth assets. You think, are you allowed to do that? Here's the good news. In finance, you're allowed to do whatever you want. Here's the bad news. In finance, you're allowed to do whatever you want. Because sometimes you wish you were more rule-bound, because you can look up a book and say, this is what I'm supposed to do. Fortunately, in finance, I can give you the principle, but then you're out on your own. You can do whatever you want within that principle. And on the other side of the balance sheet, there are only two ways you can fund this business. There's debt, there's equity. There's borrowed money or your own money. You can slice this and dice this as much as you want, but that's an accounting balance sheet versus a financial balance sheet. So that's the first stop on the road. Remember, in finance, our focus is forward-looking, not backward-looking. It's principle-driven rather than rule-driven. And it takes a while to make that adjustment, and some people just will never make it. I think accounting is on a kamikaze mission, basically, with this fair value accounting, which I think of as an oxymoron. Make up your mind. You want to do accounting or you want to do valuation. If you try to do both, you're going to fall right in the middle, and that's exactly where accounting is headed. And the reason I say that is accountants are, in a sense, I hate to do this, we're accountants, but I actually love doing this. If you're accountants, you're actually psychologically not attuned to valuation. Because all your life, what have you been taught? Make sure you get the details right, there's debit, credit, everything balanced at the end, check off at the end, you got this right. Valuation, none of those things work. So the mindset shift to me is the first part of going from accounting to finance. In fact, when you sit down to do valuation, all your numbers come from accounting. You almost have to take those numbers and say, what will they look like in a finance version of the word? Because they can look very different. So that's the first thing. Second, we talk about DCF valuations. I see people who are DCF valuation. And I'm going to start off with this basic statement that sounds absurd. But just because you have a D and a CF doesn't mean you have a DCF. You know what I'm talking about? People have a discount rate, they have cash flows, they put them together. I have a discount rate, I have a DCF model. Let me back this up. Intrinsic valuation at its core is very simple. I have a prop that I'm going to pull up. In fact, I'm often asked what the theory in intrinsic valuation is. And I almost feel like laughing because there is no theory behind valuation. Right, see that equation there? That's all of the theory I ever use in valuation. Value of an asset is the present value of the expected cash. That's one equation. I spent 26 sessions kind of fleshing out. I must really, really stretch my classes out, right? In fact, to show you how simple intrinsic valuation is, I'm going to run an experiment. And I need a couple of guinea pigs to help me on this. So somebody who's never done valuation, preferably be my choice. I'll make it look really brilliant. Anybody want to volunteer? No, I'm going to pick somebody. I don't know. So I'm going to come off. I've got reais, I've got rupiah, what kind of currencies I'm carrying. So, you want to be my guinea pig? Don't worry, you can look ready. So first thing I'm going to do is a plain envelope right there. I'm not a magician, so there's nothing in there. I'm going to put a $20 bill. Don't reach for it yet. How much did you pay for it? First rule in valuation, if you pay $20 for an envelope of $20, what do you get out of this transaction? Nothing. So let's try again. How much did you pay for this envelope? Don't think too long. That's how we get into trouble. Zero is good, but no, it's a little bit. Well, let's go $1, yeah? Because you don't know what kind of disease I have. Maybe I can't read numbers. Yeah, I don't know what this is. So maybe $1 you can get away with. But start low. You never know what you might get. But if I open this up for bidding, unless you guys collude, which I can't put past you, you're probably going to end up at roughly $20, right? Because this is easy. The value of an asset. $20, that's all it is. You don't need a DCF model to value this. Now I'm going to try to make this more valuable. So I'm going to try to sell this envelope to you for more than $20. So let me pull up the rest of the cards. I'm going to try a couple of words. What does it say? Synergy. I'm going to put this card in there. It's a good word, right? How much do you pay for this envelope now? It's got synergy in it. If you've taken a marketing class, this must have magically gone up to at least $25, right? I could write, I'll take you through the process. I could write the word control on the 3x5 card and put it in there. How much do you pay for it now? In fact, I tried this at Goldman Sachs 2 weeks ago. I put in $20 and the word control on the card, and I offer it to a banker, and he decides he wants to be clever. And he offers me $24. I sold it to him. He said, I don't need it. I said, you offered me $24. Because you know what he ended up doing then? He paid $4 for a 3x5 card with the word control on it. I didn't pay for the damn card. I stole it from the NYU stationery section. I stole the 3x5 card. In fact, I'm going to put one fun card. This is usually the trump card that admins pull out when they can't get you to pay a high enough price. What does this say? China. Just put China. I call these weapons of mass distraction. You know why I call them weapons of mass distraction, right? China, control, synergy, strategic. That word scares the heck out of me. Because it means I really don't, this deal doesn't make sense. I really want to do it. That's what a strategic deal is. A really stupid deal, but you want to get it done. A strategic buyer. If you're selling a business, look for those guys. That's a synonym for stupid buyer who makes up his mind before he shows up at the bargaining table. I call them weapons of mass distraction because they come out after the numbers have been crunched. Because you really want to get the deal done. So I'm going to state 3 very basic propositions. But I need to know something. Remember to put this because I've left $20 bills behind before, so I put it in my pocket so I don't forget it. 3 very simple propositions. Right? Can I? I'll stay at the top because you guys can't see me from the back. The first is what I call the it proposition. Now the it proposition says if it does not affect the cash flows and it does not affect the risk, it cannot affect value. See, what is it? Control, synergy. Think of what I just said. I'm not saying control doesn't have value, but for control to have value, what does it have to do? Or increase cash flows. In other words, tell me what you're going to do with control. Just don't throw it in as a buzzword and ask me to pay a 20% premium or whatever the banker says is okay. Tell me what you're going to change in a company, and then we can talk about the value of control. I'm not saying synergy is useless, but if you bring in the word synergy, I'm going to say where? Higher revenues, lower costs, higher growth. Then we can talk about how much to pay for synergy. I'm not saying China is useless, but what exactly do you plan to do in China? Another billion plus people. I don't know why India doesn't have the same kind of, a billion plus people here too. But what exactly does that do for you? Are you going to sell more? Are you going to sell at higher prices? In other words, let's start to put some flesh behind the numbers. And then we can talk about what they're worth. But let's not pay for buzzwords. Second proposition, I call this the proposition. I don't have the exact right amount of contempt that my daughter seems to get into this word. I have 4 kids, and I've discovered this very, very insidious thing that happens to all 4 of them. Around the age of 2.5 or 2, they think you know everything on the face of the earth. They come and ask you questions like, Dad, what's the meaning of the universe? And you can make up stuff, and they can't check out Wikipedia yet, so you get away with it. Then between the age of 2 and 3, probably because you make up all this stuff, strange thing happens. They go to bed one night thinking you know everything on the face of the earth. The next day they wake up and you're stupider than you were the day before. And then it's all downhill from there. And around the age of 16, you hit rock bottom, you the parent. You are now the stupidest person walking the face of the earth. So this was when my daughter got to be 16 and I was officially the stupidest person in the world, at least in her universe. We'd sit down for dinner and there'd be a topic that came up for conversation. Russia invades Ukraine, and I would feel the urge to talk about it. And I opened my mouth, my daughter would sit across the table from me. She'd give this look at me and she says, Dad, duh. And the contempt that oozed out of the words was so much that I would close my mouth. I think I had stopped talking for like 2 years. So the second proposition I'm going to call the duh proposition after my daughter. And it comes up in the second set of emails I get from people. And here's how the emails will go. I'm valuing a money-losing company. I expected to lose money forever. What's the best valuation model I can use to value the company? You feel like slapping the person around the face and wake up. You have a money-losing company. You expect it to lose money forever. You're thinking about paying for this company? Shouldn't they be paying you? So let's get this on the table. If your company is expected to have negative cash flows forever, don't pay for the company. So we got that out of the way. Let's take the third proposition. I call this the don't freak out proposition. Named after the students in my class who pick a company to value early in the process. So at the start of the first session, I said, pick a company to value, whatever you want. And around the second or the third session, half a dozen of them will show up in my office, freaked out. Completely panicked. So what happened? So I want to change companies. It's a little early. Why do you want to change companies so quickly? Because I estimated the cash flows for next year for my company and they're negative. So, remember the duh proposition? Yeah, I remember the duh. I made it up, so how can I forget it? You said that the company with negative cash flows has no value. No, this is what happens when you fall asleep halfway through class. That's not what I said. I said if your cash flows are negative forever, then your company doesn't have value. But if your company has negative cash flows up front, you could still have a valuable company. In fact, what types of businesses have negative cash flows up front? Companies at either end of the life cycle, right? Young startups and companies on the verge of death. Let's get into the second group. It's too depressing. Young startups. Why do they have negative cash flows? Because not only are they not making much money, but they have to put lots of money back. You take Flipkart. Even the most optimistic assessment of value will give you negative cash flows up front. Doesn't make them a bad company as long as you get a disproportionately large positive cash flows later in the game. I'm going to show you valuation of Twitter. It's a company I value. And what you're going to see in the first 4 or 5 years is negative cash flows. Not because I am pessimistic about Twitter, it's because I'm optimistic about Twitter. If I expect them to grow, I've got to set aside the money to cover. So file that away because that, in a sense, gives you drives value is those cash flows and the risk in those cash flows and growth in the cash flows. All too often in valuation, we see Excel models, we see numbers. But when I think about valuing a company, I think about answers to 4 questions that I need answered to value a company. Here's the first question. What are your cash flows from existing assets? If you're Microsoft, the answer is easy. You pull out your earnings report, you show me how much money you made on Windows, how much in Office. I can estimate the cash flows of existing assets. The second question is a little more messy. What is the value that you expect future growth to add to your company? Notice how I phrased that question. I didn't ask you what's your future growth. Because I know you're going to give me numbers like 20%, 30%, 50%, but I asked what's the value added by the future growth? And here's why I add the word value in front. What's a good side of growth? It makes your earnings go up faster, right? What's a bad side of growth? You've got to set aside money to get those earnings. There's a trade-off. By growing faster, and this is what I meant about young growth companies, you're going to grow your earnings, but you've got to set aside cash flows. The net effect is what drives the value of growth. So if you set aside huge amounts of money to get that growth, you could actually destroy value as you're growing, not add value. So what's value added by future growth? Third, I asked what's the risk in your cash flows? Notice what I didn't ask you. I didn't ask you what's your beta, what's your equity risk, what's your cost of equity. Those are tools you might use, but how risky are your cash flows? And then I asked, when will your business be a mature business? What the heck are you talking about? What does a mature business do? A mature business is one that grows at a rate less than or equal to the economy. Now, why I need to know that? If you go back to the previous page, what did I say the value of an asset was? The present value of the expected cash flows over its lifetime. If you're valuing a publicly traded company, at least in theory, what's its lifetime? Look at a corporate chart. It tells you when the company is founded, right? What does it tell you the company will be wound up? It doesn't. In theory, at least your company could go on and on and on forever. So to value a publicly traded company, what do you need to do? Estimate cash flows forever. That's my vision of hell. I show up in hell, I'm really pissed off, I'm in the wrong place. The devil's walking up to me, he's dressed up like an investment banker, don't ask me why. He says, welcome to hell. I don't want to be here. It's too late, you're already here. So I guess I have no choice. He says, no, you're stuck. So what do you want me to do? I'd like you to do some valuation. So okay, that's what I used to do in my regular life. It can't be that bad. So he points me to a laptop. It's a Dell. Already my vision of hell is taking form. I'm a Mac user. You give me a Dell with a bad, the pink back, the blue back, the green back. I mean, that's pretty hellish. And so what company do you want me to value? GE. It's really taking form. It's like Groundhog Day. So how many years do you want me to estimate cash flows? Forever. Spreadsheet that never ends. No wonder in the real world the question you often hear is, can I stop now? Can I stop now? Do I have to do an extra year? And I have an answer to the question. You can stop if you're willing to make an assumption, and you're not going to like this assumption. You have to assume that beyond that point in time, your cash flows will grow at a constant rate forever. Forever is a scary word, but you got to make it. You know what that buys you? It buys you an infinite series in mathematics. And 200 years ago, mathematicians solved the value of that infinite series. We stole it in finance. We act like we invented this. But this is the terminal value number that you see. But to do that, what do I have to assume? Your cash flows grow at a constant rate forever. Now do you see why I asked the question, when will your company be a mature company? What did I define a mature company to be? It grows at a rate less than or equal to the economy. Let's connect the two. If you tell me your company is going to grow at a constant rate forever, that growth rate has to be less than the growth rate of the economy. It's a mathematical problem. If you let your company grow at a rate faster than the economy, at some point in time it's going to become the economy. Then what? Oh, globalization. Keep going. In about 50 years after that, you're going to be the global economy. Then what? Interplanetary travel. There are some assumptions in valuation where you and I can agree to disagree. This isn't one of them. So when I think about valuation, those are the 4 questions, and to me, discounted cash flow valuation is a tool for answering those questions. Your cash flows of existing assets start me off. The value for growth show up in my growth rate, my reinvestment. My risk shows up in my discount rate, and then mature company assumption shows up, of course, in that final number, the big number that drives the entire valuation. So about 6 months ago, I decided to write a very perverse post on all the variations of DCF that drive me crazy. So when you get a chance, go through this list, and I'll very quickly list it up. The first are what I call chimera DCFs. These are DCFs that kind of mix together cash flows and discount rates and different currencies. In other words, they're internal inconsistencies, the mixing and matching. Okay? So you take rupee cash flows, when you discount them back at a dollar discount rate. You take dollar cash flows, when you discount them at a rupee discount rate. You take cash flows to equity and discount them at a cost of capital. You have something that looks like a DCF, but it's a monstrosity. Okay. The second are what I call dream state DCFs. You know what these are? These are companies you build on spreadsheets that nobody's ever seen before. Why not? You can do it so easily. You make your revenues 500 billion in 5 years, not a problem. Just put in an extra zero. You make your margins 80%. I call these dream state DCFs because they exist only in your dreams and on spreadsheets. So watch out for those, especially with these young technology coming out. There are a lot of dream state DCFs floating around that can exist only on spreadsheet form. The third is what I call a dissonant DCF, where basically you have a DCF where the assumptions are at war with each other. I'll give you a classic example. Company where you see the analyst projecting out hydro, which is fine. Then you get to the reinvestment, they're projecting out no reinvestment. How did that happen? You can't pick and choose, so you need internal consistency. My favorite are the Trojan horse DCFs. Remember the legend of the Trojan horse? I think it was Greece and Troy, they're fighting. There's a city that had these big walls that they couldn't get over. So the Trojans sent in a gift. Why would accept a gift? People have been trying to invade you for like months, I don't know. But the Greeks, of course, love gifts, so they said, well, bring it in. So they bring in this Trojan horse. And of course, the legend is inside the horse were 50 soldiers. In the middle of the night, they open the back of the horse, the soldiers come out, they invade the town. You say, what's this got to do with valuations? What's the biggest number in the DCF? The terminal value, right? You know what that 50 to 60% of the DCFs I see, you know what the terminal value comes from? It doesn't come from that growth rate in perpetuity assumption or liquidation value. It comes from applying a multiple. 6 times EBITDA, 10 times earnings, 1.5 times revenues. See why I call these Trojan horse valuations? You've slipped the biggest number in the DCF is not it's not a valuation, it's a pricing number that you got by looking at publicly traded companies in the space. And while I'm distracted by the cash flows up front, you slip that number in. You have kabuki DCFs. What are these? These are for regulatory purposes. Fair value accounting. A lot of kabuki DCFs. Why? Because you know what you want to end up with. This whole process about reverse engineering to that number to make it look like you hit all, dotted all your I's, crossed all the T's. You've got robo DCFs. These are habits. I don't even know what the analyst is needed there for. Everything is on autopilot, right? They're macros that push everything out. The analyst just sits there, watches. Oh, nice valuation showing up here. And finally, there are mutant DCFs. I have no idea what to even think about these valuations. The terms look familiar. The things like free cash flow. I've seen that before, but it looks, the way they're computed looks like nothing I've ever seen. A lot of DCFs out there look like DCFs, but they're really not trying to value a business. So here's my third message. Don't mistake modeling for valuation. That first day when people come into my valuation class, they all bring in their laptops with Excel spreadsheets. Because that's what they think we're going to be doing. That we're going to be doing a lot of modeling. In fact, there are outfits in New York, and I'm sure there are equivalent outfits in India that go around teaching people how to do valuation, but what they really teach you is to become an Excel ninja. You use macro, you hit these buttons together, your colors will change to blue, yellow, green, etc., etc. Modeling is not valuation. In fact, one of the first questions I ask when people walk into my valuation class is, are you a natural storyteller or are you a number cruncher? Think about it, because each of us has already made that choice early in life. You know when it happens around 8th or 9th grade, when you take that English class and you read a book, Moby Dick is a classic, and people start seeing hidden meanings. I thought this was a book about a whale. And then they read this, there were these hidden messages you can get. And at the end of the class, you walk out and go, never again am I going to a class like that. These people are crazy. They read a book and they see things that nobody's seen before. They say, Herman Melville's thinking, how the hell do you know? And he said, never again. And from that day on, it's all into algebra, following with maths 2, maths 3, maths 4, maths 5, maths 6, physics, chemistry, into accounting, business. So you never want to see a class like that, and you succeed. By the time you get into your auditing job, your accounting job, your banking job, you stay far away from the storytelling classes, and then you come back to an idea. You're in my class. But 2/3 of my class were natural number crunches, selection bias. But remember, I said MBAs are changing, so I get a lot of history majors and literature majors who really love that. They love that. Don't ask me why. They love that English class, and they made that their area where they take, they become history majors, and they become, they go to work as journalists, and then they come back to business school. They end up in my valuation class, the storytellers. And I give them what my end game in this class is. Because here's the way I think about valuation. Valuation is never just about the numbers. It's about connecting stories to numbers. That no valuation should ever be all about the numbers. There should be a story that backs up the numbers. And valuation is the bridge between the two. So I tell them what my end game is for the class, and I don't always succeed. I say, to the number crunchers, I say, I want you to develop an imagination. And to the storytellers, I tell them I want you to have discipline. By the end of the class, hopefully, if I can get disciplined storytellers and imaginative number crunchers, I've done my job. So let me take you through this process of going from story to numbers. And I'm going to take a company that I'm sure you're all familiar with, which is Uber. So in June of 2014, I read this news story about Uber. And to kind of reflect my age, I read the news story and I didn't know what Uber did. But what jumped out at me was that people were attaching a value of 17 billion to a private company I'd never heard of before. It's going to be interesting. Let me try to value the company. And as I said, I didn't know what they did. So the first thing I had to figure out was ask me, what exactly does Uber do? So basically anybody under the age of 25 said, I know what Uber does. I use them all the time. So I spent the first 3 weeks, actually, all I did was I put the Uber app on my phone. I called up Uber even though I didn't need a car. I'd get in the car and say, drive me about 15 minutes in any direction. And I peppered the guy with questions. Why do you drive for Uber? How does this work? So I was kind of done. So at the end of those 2 weeks, I thought I had enough of a sense of what Uber did that I could develop a story about the company. Here's the initial story I told about Uber. I said, Uber is an urban car service company. Parts of the story, you're going to see why this matters. An urban car service company with significant competitive advantages because of the way it's structured, and local networking benefits. What the heck are you talking about? In technology, there is this networking benefit that people talk about, which effectively means that if you become a larger company, it becomes easier for you to become, because most businesses, as you get larger, it gets more difficult to scale up. In technology, there's a tipping point. Where if you hit that tipping point, it becomes easier for you to grow rather than more difficult. And then it becomes winner take all. So Google in the search engine space, eBay in the auction space. So that's a global networking benefit. I argue that Uber was more likely to have a local networking benefit. Let me explain what that story is going to mean. That if they become the largest car service company in LA, there's a tipping point at which Lyft will drop off the equation. Because if you look at your Uber app and your Lyft app and install both, if there are 10 times more Uber cars than Lyft cars, guess what? When you look for a car, an Uber car is going to be closer to you than a Lyft car. So there's a tipping point. So I said that's a local networking benefit. But if I land in Jakarta, as I'm supposed to on Wednesday afternoon, I have the Uber app on my phone. The fact that Uber is the largest car service company is kind of irrelevant because what do I need to do? I need to get a car to get from Jakarta airport to a hotel. And if there's an Indonesian car service company that has 5 times more cars than Uber does, what do I care that Uber is the largest car sharing company? So my initial story is the urban car service company that's going to expand the car service market because there'll be people who used to take mass transit or didn't take cabs who might take it. With a significant competitive advantages, but this local network. Farther away, that was my initial story. My next step was to stop and ask, does that story hold up? And there are 3 P words that I'm going to introduce in the process to check your story. So the next time you're sitting across from some young startup's founder saying, this is what we plan to do, think about these 3 P words. First is a very simple test. Is it possible? You better pass that test. Because you're telling me a story that's impossible, the whole thing's off the table, I'm walking up. The second is a slightly tougher test. Is it plausible? Is it possible to plausible? You're already going to have to pass some tests. So, I've tried this out, it worked here. And the third question is my fun test. Is it probable? Possible to plausible to probable. And at least with Uber, here's what I saw their business model. I saw their car service business as a problem business. There was enough evidence in the ground that they were going to succeed in this business for me to pass the problem. They were entering into moving business and delivery businesses, and that seemed plausible. And there was also talk even then of how Uber could replace your second car or have driverless cars, and that seemed possible. It didn't even get to the plausible. But at this stage of the test, I'm just making sure I'm not telling a fairy tale. I want to make sure I'm not into fantasy land, that I have a story that actually makes sense. Once I have that story, I've got to connect it to the numbers. So I'm looking, and this is the place where I think you get tested. Because anybody can tell a story, but to convert that story into numbers, I've got to find the numbers to move. So I use Uber to kind of illustrate how this story plays out. Let me take the Uber example. What did I call it? An urban car service company, right? So the potential market is the urban car service market. So my first decision to call it an urban car service company determined the potential market. And in 2014, my estimate of the size of that market is 100 billion. I have a really scary story to tell you, those of you who use Google search. I defined the size of, so basically I want to find how big is the global taxi market. There's no one place I could find it. So I went city by city. So in LA it was easy, in New York it was easy, in Tokyo, because the local limousine and taxi commissions had the data. I collected this for about 10 cities, and then I ran out of data. So if I ask you how big is the taxi market in Chandigarh, it's not as if I can pull it up somewhere. So I started making these judgment calls, estimates, guesstimates, and I kept going. And I finally ended up with a number of 100 billion as my estimate of the global urban car service company. So this is basically over a 2-hour period, sitting in Google search and making up stuff. I ended up with 100 billion. If you go to Google search right now and type in size of the global taxi market, guess what shows up as the first item? My 100 billion. I know how little real data went behind it, and it's kind of scary. This shows up now as the, so I see a journalist quoting the size of the market is 100 billion. I'm afraid to think how far this has spread. But my judgment in calling this an urban car service company determines my potential market. By the way, it's a $100 billion market. Now, what percentage of that market they will be able to command goes back to whether that, I think there were local networking benefits or global networking. Because I made the judgment that their networking benefits would be localized, I gave them a 10% market share. That doesn't sound like much, but remember, this is an incredibly splintered market right now. The largest car service company in the world probably has a 0.1% of market share. I'm giving Uber 10%, but I'm not giving them 40%. I gave them strong competitive advantage. What does that mean? You know how Uber makes money, right? They don't own the cars, they don't hire the drivers, but when you pay for an Uber drive or an Uber ride, 20 cents in every dollar goes to Uber, 80 cents goes to the driver. That's why competitive advantages come in. That number is going to come under assault because competitors are going to go to drivers and say, we let you keep 85%, we let you keep 90%, and I'm assuming the competitive advantage is strong enough that they can keep that 20-80 split. What I'm trying to say is every number in my valuation goes back to something in my story. And by the time I'm done, my valuation actually is reflecting what I told in my story. And if I pull the numbers together, this was my valuation of Uber in June of 2014 as an urban car service company with a $100 billion potential market and 10% market share, an assumption that they can keep doing business the way they are now, which is to treat the drivers as independent contractors, not own the cars, have a low capital intensity, be able to grow fast. The value I got was $6 billion. And I put that on my blog and I said, you know what, I'm not trying to dissuade you from, that's not my job, dissuade you from investing. But this is what I think the company is worth. And I thought, you know, I'd post it and I don't expect very many people to read it. And somehow it got picked up in Silicon Valley as a direct attack on venture capitalists. Don't ask me why. I didn't even mention venture capitalists. And one of the lead VCs in Uber, a guy called Bill Gurley, decided about 3 weeks after my post that he had to respond to me directly. Bad idea. To respond to somebody who has absolutely no stake in the battle. I don't know why you do it. But I was sitting in an airport, I think it was in Munich, and I was waiting for a flight. And I look at my email, and it's from Bill Gurley saying, I've just put a post on my blog about your valuation. And I want to tell you in front that I've been very, I don't even know the right word, blunt about it. Well, let me go check out what he said. And I look at the title, it says, Damodaran misses by a mile. I guess good play of words with Uber being, And then he had the whole list of things that he disagreed with me on. He said, first he said, Uber is not just an urban car service company. It's going to be all over the country. Second, he said, it's really not even a car service company, it's a logistics company. See how words can make a difference? Yes, there is a difference between a logistics company and car service companies. Car service companies is taxi service. Logistics companies, anytime you have to move items or people from point A to point B, we're going to be there. And third, he said, we have global networking benefits because we're going to connect to the credit card companies, and you're not going to trust an Indonesian car service company with a credit card, are you? We're going to find a way to do it. And I think he expected me to come back to him with this defensive point. And I said, you know what, this is great. You've given me an alternative narrative. You know more about the company than I do, which he does. So I emailed him and said, would you like me to value your narrative? He said, what are you talking about? So you've told a story about the company. You haven't used a single number. Would you like me to take your story and show you what the value would look like with your story? He said, be my guest. So I went in and revalued the company. Here's how the story affects valuation. First, I took the urban car service company and I replaced it with a logistics company. And all of a sudden, my potential market is no longer 100 billion. It's 300 billion. I'm going after a much bigger market. I took the 10% market share because he claimed to have global networking benefits. I said, okay, that gives you a 40% market share. I'll give you a 40% market share. He mentioned nothing about the profit splits. I left it at 80-20. So I put this on my website and said, well, Bill Gurley's story gives me a $54 billion value. And then he emails me almost right away and says, I forgot to mention the story that I think that this 80-20 split is going to become much smaller. It's going to be probably 90-10. I said, not a problem. So 15 minutes later, I put an added valuation saying, this is Bill Gurley's narrative, adjusted for this new thing that he told me about. And it's 28 billion. So what's Uber what? Depends on the narrative you have for the company. What's Flipkart what? It depends on your narrative for the company. I get constant calls from people, especially journalists, saying, are we in a bubble? How do you explain what people are paying Uber? First, I can explain what somebody else is paying. Ask them. Okay? Second, it's not my job to say that's a bubble, they're being crazy. Because I want to give them the benefit of the doubt that they have a different narrative for the company. They're willing to put money behind the narrative. So what if the bubble bursts? Well, that's their money to lose. Why are you so worried about it? Just think of it, fixating on bubbles and when the bubbles will burst and how terrible this is. I think this is designed by these old-time value investors to make themselves feel better. Because look at those crazy people. They paid 5,000 times revenues. They're all gone crazy. It's not your job or my job to pass judgment on other people's narratives. If Flipkart comes and says, would you invest money? If you have a narrative that gives you a value greater than 16 billion, go ahead. If your narrative doesn't give you a value greater than 16 billion, don't join in. But let the people who are playing the game play the game. It's their money. They want to basically attach a number. Let them do it. To me, this is the piece of valuation that we don't pay enough attention. I often I'm often asked to comment on a banking valuation. Analyst has done it. And often, the only question you often need to ask to see if the banker really understands his valuation is to ask a simple question. What's your narrative about the company? You know what the banker's reaction is? What do you mean narrative? Look, there's an Excel spreadsheet. I've got revenue growth, margins, it's all there. You want me to tell a story? Yes, I need the story that drives these numbers. Without a story, all you have is a collection of numbers that you can move around to get whatever number you want. This is about getting the story right. So as you look at these e-commerce companies and you say, or the social media companies, don't jump to the immediate conclusion that just because the pricing at these companies doesn't meet your metric requirement, that PE ratio should be less than 15, doesn't mean that the companies are overpriced. It might mean that the narratives have gone off the tracks. But that's what you're trying to figure out. What about the story doesn't make sense? And I'll tell you one thing about these stories that I would be careful about is there's what I call the macro delusion. You know what the macro delusion is? When you sell companies, when you value companies, when you put numbers in companies constantly based on the macro story. Right now, for instance, social media companies, the macro story is there's a big online advertising market out there. Therefore, we're worth a lot of money. The story makes sense, right? It is a big market. It's getting bigger. Right now, this year, for instance, online advertising was $130 billion globally. It was about 1/5 of all, in fact, a little more than that. It was about 22% of all global advertising was online advertising. We know that that number will grow. And even if you have an optimistic view, that number is probably going to be about $350 billion in 10 years. And the reason I bring that up is about a week ago, I started collecting the market prices of every publicly traded social media company in the world. So these are market prices, and they're all set high. And then I computed an imputed revenue in year 10 based on the market price of 10. You see what I'm trying to do? I'm saying, hey, I know what you're pricing it at. What would the revenues need to be in year 10 to justify the price of 10? I'm not even saying it's right or wrong. Let me just get those imputed revenues. And I added up all those imputed revenues 10 years from now. And I got $420 billion. Houston, we have a problem. You see what the problem is? The entire online advertising market is $350 billion. But companies, these are just the public companies. I'm not even counting the companies that are waiting on the sidelines. Companies like Snapchat that haven't gone public. Just taking the public companies in the space, I'm coming up with total revenues that exceed the entire market. That's what I call the macro delusion. And the reason it happens is people are not asking the right question. They're letting the macro story drive their investing rather than stop and ask how big is the market, what's your market, because they think that's too uncertain. So we can't deal with it, let's not even ask the question. One final point about these narratives, especially young companies, is don't let hubris become your enemy. Don't say, I have a narrative, I really like it, I'm not going to move no matter what. Because your narrative can shift, it can change, or it can even break. Let me take the most extreme example. How about you've heard of a company called Aereo? It was at the middle of last year, what Aereo allowed you to do is watch cable channels on your iPhone or iPad without paying cable fees. Sounds too good to be true, right? But they found this way in which they could tap into the cable and essentially so you could watch the channel. And they would charge you $8 a month or something instead of the $80 you pay cable. And they claimed to have found a legal way. Of course, the cable companies disagreed, so they sued, and the lawsuit worked its way all the way up to the Supreme Court. And last June, the Supreme Court finally came up with a judgment that this was not legal. Aereo had a value of $2.5 billion the day before the judgment. You know what its value was the day the judgment came out? Was nothing. That's a narrative break. The whole story is now gone. Pray and hope you'll get a narrative break for the company investment. Narrative changes and shifts are more subtle. There are news items that change the way you think about the company. I'll give you a couple of examples of Uber. About 3 weeks ago, the California Labor Board made a judgment that Uber drivers were not independent contractors, they were employees. You see how that's going to affect my valuation? First, if they're employees, you have to pay social security tax and others, so the cost will go up. The second is, if you're now suing the Uber driver, Uber is going to be, so if you have lawyers going after deep pockets, you now expanded the liability. So when I heard that news, my first reaction is I have to go back and revalue Uber because this changes the story. A week after that, I get this email from Uber Eats. You know what that was. And this is a new service they offered in LA, which is actually delivering food in LA. So when you order food from a restaurant, Uber Eats delivers it to you. It's just my business. I have to go back and revalue Uber. But I tell you, even small things can change. About a year ago, my son, who's now 16, had a friend over. And you know the car service, I live in the middle of suburbia. You know the car service in the middle of suburbia? It's called the mom car service. Which is usually when the kid has to be picked up, the mom drives into the driveway, picks up the kid, drives back home, and so the kid, it's time for the kid to leave 6 o'clock. Car pulls into the driveway. It's a car I've never seen before. Strange guy sitting in the driver's seat. So I turned to this kid and said, What's that car? That doesn't look like your mom unless she's grown a beard and a mustache in the last 6 months. He said, that's an Uber car. My first reaction is I have to go back and revalue Uber. You see why, right? What was my original narrative Uber? The urban car service company. I'm right in the middle of suburbia, and a mother has trusted Uber to pick up, I would say, her most prized possessions, but that might be one of the top 10 prized possessions. That changed the way I think about Uber. So what I'm saying is small things can change your narrative. Be ready for that feedback, because that's what gives you a good value. Fourth lesson. And this is particularly hard on some groups of people, and as I identify them, you're going to see if you're one of them. We've been taught all our lives, if you do things right, you get the right answer. Right? It starts when you're 4 or 5. You go off to school, teacher comes and puts a sheet of paper in front of you. 2 plus 2. You get 4, congratulations, you got the right answer, you did everything right. You get any other answer, you got the wrong answer, you must have done something wrong. And that gets drummed into you all the way through school. And God help you, you become an engineer or a mathematician, because you get 5 more years. If you do things right, you get the right answer. If you got the wrong answer, you must have done something wrong. And many of them, they start to become engineers, and after about 3 or 4 years, they discover they're not paid that much. They come back to business school. They're in my valuation class, they're recovering engineers, or whatever they decide to call it. And they value a company. And I'm like clockwork. I can predict what's going to happen around the 11th and 12th week of every semester. About a half a dozen people in the class, mostly engineers, will show up in my office. They put a valuation down on my desk and say, I value my company. Can you take a look and tell me whether I got the right answer? I didn't take a look, push it back across the table, and I say, you know what? I don't know what the right answer is. And you can see that faith in the system start to crack. You're teaching this class, you don't know what the value of every company is? If I knew what the value of every company was, why the heck would I be teaching this class? I'd have my own island in Hawaii with a castle on top of it. And at that point, you get a splintering of the group. Half the people can't handle the fact that there's no right answer. Do you know what happens to them? They become fixed income people. It's a lot more comfortable sitting there with a bond, right? The maturity is given, the coupon is given. I know you're worried about default risk, but it's so much more confined. You don't have to think about revenue growth and margin and all those other distractions. I let them go. It's a healthy recognition early on that value equities is not for you. The other half said, this is kind of fun. If you don't know what the right answer is, I can never ever conclusively be wrong. This is one of the great things about equities. You can never ever conclusively be wrong. You tell me to buy a stock, it goes down 27 years in a row. You know what you tell me? Not a long enough time horizon. You asked me to buy Lehman in 2007, I come back and say, what did they make me do? I said, they only hadn't gone bankrupt. They'd been trading at 4 times the price today. The system got in the way. I think it's great not having the right answer, but psychologically, it's stuff for something to happen. Because at the end of evaluation, you want to check. Did I get the right answer? And what I'm saying is, there is nothing I can show you that says you got the right answer. And in fact, this problem becomes particularly difficult with young startups, so there's a lot of uncertainty. Remember those 4 questions I asked you? Let's assume you're a young startup. Let me ask you those same 4 questions. You're the founder of a young startup. Lots of potential. That's a scary word. Another weapon of mass distraction. Potential. So the first question I ask is, what are your cash flows for existing assets? What's your answer to that? What existing assets? I don't even know the chair I sit in. So that was easy. So there's nothing. Put 0 in there. Then I ask you, what's your value from future growth? You say a lot. You can you be more specific? Not really. You don't have a business. You don't have a model. You don't have any history. So I'll accept the law. Now, how risky are you? Very. There's again nothing I can look at, right? No earnings, no cash flows, no prices. When will you become a mature company? You fall on the ground laughing. You don't even know whether you'll make it through tomorrow. With young startups, you see why valuation is difficult. Every question becomes more difficult to answer. And at this stage, you're going to be tempted by what I call the dark side. Know what the dark side says? No rules don't apply. You can't really value companies. There's too much uncertainty. That's the classic. There's too much uncertainty. So here's what you should do instead. Make up a metric nobody's seen before. Price per user, that works well. Price per download, how about that? Price per website visitor, remember the previous iteration, price per eyeball, that was my favorite. Mary Meeker invented this, where she took the market cap of every company and divided by the number of minutes people were looking at your website. As you could suck revenues out of people's eyeballs. $300 per eyeball. But you make up these metrics, and every time I ask you about a company, rather than talk about the company, you talk about this macro stuff. So why do you like Facebook? Because my daughter's on Facebook 16 hours a day. What's that got to do with it? But I'm supposed to extrapolate that. Why do you like Alibaba? China. Kind of settles it. You throw a macro story because you really haven't thought through the micro stuff. And you play the momentum. Basically, say, I don't know what the value is. I'm going to look at what other people are doing and I'm going to do the same. And that scares me. It scares me because I think it's so easy to get off track. If you don't have an anchor, which is what value is, I'm not saying you have to know the value of everything, but you have to have some sense of what the value of the company is. But most people don't even want to try because their argument is too uncertain. My response is, just because there's uncertainty doesn't mean you can't value a company. You've got to do the best you can with the information you have and accept the fact that you're going to be wrong. What percent of the time? 100% of the time. So let me take an example. For the last 5 years, every time one of these big, high-profile social media companies has chosen to go public, I've played a little game, which is about 4 weeks before they go public, or when they make the announcement, they have to file a prospectus with the SEC. Essentially, it's like basically an annual report before you go public. And the day they filed the prospectus, I tried to value the company. So I did Facebook and LinkedIn, I did Twitter. I do the valuation before the bankers actually put an offering price on the company, because the minute you know what the offering price is, it acts like a magnet on your valuation, whether you like it or not. So this is actually a good time to value the company because there's no number out there. So I chose to value Twitter when they decided that they were going to go public. They took the prospectus. And here's what they showed me they did last year. They didn't sell much. Their revenues were about $500 million. They lost money, $135 million. Nothing here is a surprise. $135 million loss. And even if you give them the benefit of the doubt and saying R&D expenses shouldn't really be operating expenses, they're really a small company not making much money. So I said, I'm going to value the company. Now, to value the company, the first thing I have to ask is, what business are they in? What business is Twitter in? It's not a social media company. It's not a business. That's what business are they in. I'm asking, how do they expect to make money? So let me ask you a question. What business are they in? How does Twitter make money? Or try to make money? It basically, you've seen sponsored tweets, basically it's advertising. So to value Twitter, what do I need to do? I need to get a sense of the online advertising market and what percentage of that market I think Twitter will command. So I'll make a confession. I don't know how big the online advertising market was, but what scared me was that I was on CNBC the day the prospectus was filed, and there was an analyst, for some reason they paired me up with this really bullish analyst of the same company, whatever the company is. This guy was really bullish on Twitter. He said, Twitter's worth $60 billion. And I said, why do you think it's worth so much? I was just curious. And he said, the online advertising market is huge. I said, really? How huge is it? He said, I don't know. But it's huge. And I said, you really want me to take your recommendation of a company based on a huge market when you don't know how huge it is? He said, yeah, who cares about how huge? It's huge. You know what? That works for you, it doesn't work for me. But it's good that I had that conversation because it laid out the first step in this process. I had to figure out how big the online advertising market was to get this valuation started. And that's what I started with. I just took, in 2013, I looked at the numbers, and this was actually fairly easy to get. The global online advertising market was about $117 billion. And it was about 1/5 of all advertising globally. So first what I did was I projected out what I thought the market would be in 10 years. And based on my estimates, the value that I got for the projected online advertising market in 2023 is about $250 billion. I'm getting one step closer. Now I turn to Twitter. What's the question I'm asking? What percentage of this market do I think Twitter will command? Can it be Google-like and have a 30% share of the market? Or is it going to be something smaller? And in my judgment, I made the decision that Twitter was going to be a successful online advertising company, but not a dominant one. And here's the reason. What's Twitter's strength? What makes it such a powerful social media device? 140 characters, or is it 160? Whatever it is, I always run over and they make me cut off things. It's 140 characters. That's its strength. What is its weakness? It's 140 characters. If you have an ad, what does it have to do? It has to fit in 140 characters. Now do you see why I see it as a secondary advertising place, right? A company can't do all its advertising in Twitter. You can't fit everything in 140 characters, but you can do a Facebook ad and a Twitter ad. So what? Well, if you're not a primary advertising place, you're not going to be a 30% market share, 20% market share. You're going to be lucky to get up to 10%. And my initial valuation, I gave Twitter a 5.7% market share of the market. I'll let you figure it out. So I gave them a 5.7% market share. 5.7% of 250 billion gives me revenues of about 11.5 billion in year 10. So half my game is done. Now I have an estimate of what the revenue should be in year 10. But I have a second half of the equation, right? For Twitter to be worth money, it's got to make money off these revenues. I had to estimate a margin. There are two big players in this market, Google and Facebook. Google makes 22% margins. Facebook makes 30% margins. I put Twitter right in the middle, 25% margins. As an advertising company, you don't have big capital expenses. Your expenses should be low. I gave them 25% margins. So in year 10, their margins are going to be 20. Right now, remember, they're losing money. They have $500 million in revenues. By year 10, I'm giving them $11.5 billion in revenues. And I'm allowing them to make a 25% margin. That's my vision for Twitter in 10 years. An online advertising company that is going to be successful but not a dominant company. And one final piece of the puzzle, I require them to reinvest about $1.50 for every dollar of revenue they would add, based on their own history. That's the narrative. My narrative for Twitter is going to be a successful online advertising company, but not a dominant one. An extremely profitable company that shows up as higher earnings, higher cash flows. That narrative is what's going to drive my valuation. Have you ever done a discounted cash flow valuation though? What's the one number I haven't talked about yet? I've talked about revenue. I haven't talked about discount rates. And I'll make a confession. It was about 11:25 when I finished the cash flows, and I had a class at 11:30, and I wanted to get my valuation done before I left for class. So I spent 4 minutes on the discount rate. And I emphasize that. Young startups, if you're going to screw up, it's not because you got the discount rate wrong, it's because you got the cash flows wrong. And I gave them a discount rate. I gave them a discount rate of about 11%. I'm not even going to give you elaborate defenses. That's a 90th percentile of cost of capital U.S. companies. And I said, you know what? I'm making them as risky as the 90th percentile. That's going to be the cost of capital. If you're valuing young startups, don't spend 80% of your time estimating cost of equity, it's not where your real time should be spent. It's in estimating markets and market shares and margins and cost of capital. I pull those numbers together. The value that I attached for Twitter in October of 2013 was about $18 per share. I thought I was being pretty optimistic, going from $500 million revenues to $11.5 billion, making it a profitable company, bringing in a risk profile that reflected the company. But the reason I say that, of course, the initial offering price was set at 22. That offering price was raised to 26. And on the day of the offering, actually, they made me come in and sit in. I think it was in CNBC. Not at 9:30, they'll open, and then I can give a little whatever is my spiel, and I can get out by 9:45. I get in, I got in half an hour early, 9 o'clock. 9:30 comes, the stock doesn't open. It didn't open till 11:30 because there was an imbalance. That's what they said. There was an imbalance of orders. When it opened, you know what price it opened at? 46. And of course, I get that obligatory call at the end of the day from Wall Street Journal saying, well, how do you explain the 46? To which my response is, I didn't pay it. Ask somebody else. But then they said, well, how do you explain the fact that your value is different from the the price. I said, that's my value, that's their price. Why do I have to explain it? I value Twitter every quarter since. The value's kind of gone from 18 to 21 to 22 to 23 to 25. The stock opened at 46, it got all the way up to 76, I think, at the start of this year. My most recent valuation of Twitter was $25.83. I'm going to put that up tomorrow. You know what the stock is right now? At 27. I just put a limit buy on Twitter on my brokerage account for 2,000 shares at $25 per share. And the reason I say that is not that I think I'm going to be right, but I see people often ruling out entire groups of stocks, saying, I will never buy a Facebook, I'll never buy a Twitter, I will never buy a Google. Why? My most recent valuation of Twitter was $25.83. I'm going to put that up tomorrow. You know what the stock is right now? At 27. I just put a limit buy on Twitter on my brokerage account for 2,000 shares at $25 per share. And the reason I say that is not that I think I'm going to be right, but I see people often ruling out entire groups of stocks, saying, I will never buy a Facebook, I'll never buy a Twitter, I will never buy a Google. Why? At the right price, you should be willing to buy any stock, and at the wrong price, I don't care how great the company is, it's not worth buying. My problem with Twitter was never that I didn't like the company. And that's, I think, part of the problem I face. When I do evaluation, people think I have some hidden agenda against the company, that I hate Facebook and hate Mark Zuckerberg. I have too many other things in my life to worry about hating Mark Zuckerberg. I value the company because I'm curious, but I also value the company because if the price is right, I'm interested in the company. So I bought Facebook at 18 because the stock had dropped to 18 after its first earnings announcement. I sold it at 45 because I thought it was fairly valued at 45. Of course, I sold too early. It's at 95 right now. But I'm not going to regret selling too early because I have to stay consistent with what brought me to the table, which is value. And on a value basis, it doesn't make sense. So I'll buy Twitter at 25. You know what's probably going to happen? Probably going to go to 50. So what? Time is my ally. Only one person to answer to it. He's very, very understanding, which is me. Why do you buy the stock? Brilliant move. Just stay there. Actually, I had to explain to my spouse as well, but about 3 years ago, I turned off all the brokerage statements that come to our house. It's all paperless now. She has no idea what's in our portfolio. They can always blame the kids. They bought her. I have no idea how that happened. But one final point about these young startups, and this is something that allows me to maintain my sanity, which is I'm making a lot of estimates, right? Size of the online advertising market, the market share, the margins, and I have to understand that I'm going to be wrong, and horribly wrong on some of these valuations. So I'm sure there'll be people who email me a year from now and say, how do you know this? That stock you valued at 25, it's now at 5. It happens. And it's not my fault. You know what? I don't have to be right. I just have to be less wrong than everybody else. That takes a load off your shoulders, right? Because essentially it says this is not a game of being right, it's just a game of being less wrong. And I think I have a better shot of being less wrong with the Twitters and Facebooks of the world than I do with the Coca-Colas and the Procter & Gamble's. I know we're getting very close to the end. I have no idea what the time is. I leave my clock, I watch it to your time. What time is it? Okay, I have enough time. I want to draw a contrast between two words that I use interchangeably that I think we should stop doing. You know what the two words are? Price and value. This morning, for instance, somebody said, how do you explain the valuation of Flipkart at 16 billion? This might seem like nitpicking. I said, stop. It's not a valuation, it's a pricing. And I'm going to argue that 90% of what you see out there that passes for value is not value, it's really pricing. And to draw the contrast, let me explain where the two numbers come from. Value is driven by cash flows, growth and risk, all the things we talked about, the big questions. What's price set by? Demand and supply. That's it. What drives demand and supply? God only knows, mood, momentum. It's a different game. There's a pricing game and there's a value game. The value game tells you what the value is. The pricing game delivers a price. And only if you believe that markets are efficient do the two numbers match up. If they're not efficient, the pricing game can deliver a very different answer to the value game. Let me give you some examples to draw at this conference. How many of you own an apartment or a house? Come on, you can't be that poverty-stricken. Think about the process by which you bought this apartment or house. You hired a realtor. The realtor showed you the house or the apartment. They named a number, right? How did the realtor come up with that number? They looked at other houses that sold in the neighborhood. They adjusted to the fact that you have an extra bedroom or a smaller lot and said, hey, you know what? When you buy real estate, that's what it is. In fact, this is something we've been going through for the last 3 winters in New York have been horrific. My wife's from California and I want to get back to warmer weather. So last winter I said, this is it. I'm done. Let's move back. I didn't even finish saying it. She was on the computer checking out houses already. And she picked, for whatever reason, the most expensive part of California to start a loan. It's La Jolla, where $1 million house is cheap. She said, I found a cheap house. Why? Because there's only 6 digits in there. It's $995,000. This is I think Redfin. But Zillow, there are all these ways where you could go up and look at a house, there's a number on it. But if you think about how that number is set, it's by looking at other houses in the neighborhood. Houses are priced, they're not valued. Priced because you're looking at other houses, what other people are paying for them, you come up to them. You see those unsophisticated realtors. Picked up equity research report. You've seen your share of these, right? I've hidden the name of the equity research analyst to prevent any embarrassment that might occur. You know what the typical format for an equity research report is? There's a company name, there's an equity research analyst name, there's a buy or a sell, or that chickeny poll, whatever that is. Or even more Weasley, the strong buys, the weak buys, the semi-strong buys, which I've never understood. I've tried getting online and said, I'd like to do a strong buy. It doesn't work for you. You either buy or sell, but you dance in the middle. But then there is that story about why the analyst thinks the stock is cheap. He says, this stock is cheap because it trades at 12 times earnings. But these 15 other companies that are just like it trade at 15 times earnings. Remember that realtor? Set the price for the house based on the 6 houses that it sold recently. I think the realtor is much more solid ground than an equity research analyst. Because I can actually find houses in the neighborhood that look like yours. Your pricing, Microsoft, how the heck did you find 15 companies just like Microsoft? What alternate universe do you wander in? We find all these companies. But when you see a multiple in comparables, don't let the word value pass your lips. You're pricing this company, and that's perfectly okay. The third example, of course, is there's a discounted cash flow valuation, the price driving determinant value, but that's pricing. If you ask me what the determinants of price are, notice that none of the items that I showed you for value shop, there's no cash flows, there's no growth, there's no risk. Here's what drives price. First, there's mood and momentum. If you're in a good mood, you're going to push up the price. In fact, there's a study that looked at what happens in big soccer countries the day after the country's soccer team loses in the World Cup or something, like Brazil. You know what, stock prices drop about 3% the day after the country's soccer team. So what happened? My cash flows changed? No, you just came in a bad mood and you sold everything. Mood and momentum. Liquidity. When you talk about liquidity, you talk about a pricing issue. What I call incremental information. People react to these things and look and say, you reacted that much to that item? I remember about a year ago, right after the iPhone 6 came out, Apple stock price dropped like 3% in like 2 minutes. 3%, that's what, 3% of 700 billion is 21 billion value gone. People are trying to figure out what happened. And it turned out that what the market was reacting to was a Twitter post from somebody who claimed to be in Shanghai in front of the Apple iPhone store, and he was saying there's no line in front of the iPhone store. This is what? So first, we don't know whether this guy is even in Shanghai. He could be sitting in Silicon Valley looking out of his window at the wrong store to begin with. The store might be closed for the day, Or he could have just made up the whole thing, but 21 billion in value knocked off in no time at all. I mean, how much value has Apple lost just since the last earnings report? 100 billion plus? So it's lost the equivalent of Greece. All gone. For what? What was in that earnings report? You know what the big story was? China. That's what I asked the analysts, why did you knock that value? China. Remember when China used to be a good thing, now it's suddenly become a bad thing. So what about China? The Chinese economy is slowing. And you discovered this after the Apple earnings report? What was it in this report that showed you that the Chinese economy was slowing? But after the fact, people make up all these reasons. It's incremental information. You know it is completely disproportionate, but that's the nature of the pricing game. There's a lot of groupthink. Because what drives prices? Look at what other people are doing. I mean, this morning somebody was talking about institutional investors versus retail investors. The assumption is retail investors are stupid people who really don't know what they're doing. Institutional investors are smart, sophisticated people who think on their own. They do these valuations. I said, you know what? The stupidest people I've ever seen have been some institutional investors. Because here's what happens. Retail investors have lives of their own. Right? They're doctors. They don't have time all day to sit around and talk about stock. The problem with institutional investors is they hang out in the same places and all they talk about is stocks. So it's almost like a virus, an Ebola virus that picks up. Bad mood at lunch, it spreads across the table. And they all go back to their desks and they spread that disease around. By the end of the day, market's down 10%. What happened? Something in lunch didn't agree with me. This rippled through all the way through. So there's a lot of groupthink in this process, and it's not just small investors who do it. It's essentially anybody who does pricing, because that's effectively the way you catch numbers. So when you see multiples and comparables, that's what you see. You pick a multiple, you pick these comparables, and then you tell me a story. You're doing the pricing. Let's call it exactly what it is. It's not a valuation. It's pricing. I tell people, play the game you came to play. If you came to play a pricing game, play the damn pricing game. What's the essence of the pricing game? You buy at 50, you sell at 60. You buy at 60, you sell at 70. Who cares what the value is? As long as there's a person on the other end that you can sell to a higher price at, it really doesn't matter. That's what's driving the pricing of all of these social media companies. It's not that people think that Uber has a value greater than 51 billion. There might be a few actually think it through. You know why people are investing in Uber at 51 billion? Because they don't want to be left out of the game. And they think they can go public at 80 billion. It's as simple as that. It's a pricing game. And that pricing game essentially is what's driving the numbers. So I decided to revisit Twitter and do a different thing. Remember I tried to value Twitter with all those cash flows and revenue growth and market share and margins? I decided to price Twitter. So to price Twitter, what do I need to figure out? How are investors pricing other social media companies, right? So I took every publicly traded social media company, I looked up their market cap, I looked up every number I could find on these companies, earnings, revenues, etc. And I decided to do some basic statistics. I said, what number best explains differences in pricing across social media companies? I did a correlation matrix. Remember those from statistics classes? You say, what variable is most correlated to market pricing? And then maybe I shouldn't be surprised, but I was mildly surprised at the result. You know the variable that best explains differences in market prices across social media companies? It's how many users you have. The correlation is 98%. You tell me how many users you have, I'll tell you what your price should be. In October 2013, across social media companies, investors were paying about $100 per user. 97 point something, you don't have a precise number, but $100 per user. You want to price Twitter? Here's all you need to do. Ask them how many users they have. 240 million users. Finish the story. So what price should you attach to Twitter? 240 times 100 is 24 billion. You're done. That was roughly where they went public at. I spent all this time estimating cash flows and growth. Why? But if you ask me to price Twitter, I should just take the number of users and multiply by 100. If your job is pricing, don't make this any more complicated than it needs to be. If the price of your house is based on how many chimneys you have, count the chimneys, multiply by the number price per chimney, you're done. And if you're a homeowner, build more chimneys. That's what people are paying for. You don't need a fireplace, just build an ant chimney. And I think that's relevant because if you're a social media company and I'm paying you $100 per user and you want to increase your price, what are you going to do? Go add more users. Remember when Facebook bought WhatsApp? How many of you have WhatsApp? Pretty much everybody, right? How many of you pay for your WhatsApp? Pretty much nobody. If you're putting a hand up, you're the sucker in this room. You might be the only person in the whole room who pays for WhatsApp. But in February of 2014, Facebook bought WhatsApp for $19 billion. And of course, you look at their revenues, their earnings, there's nothing there. Again, you get this Wall Street Journal report saying, how do you explain Facebook paying $19 billion? You couldn't get in touch with Mark Zuckerberg and ask him the question. I didn't pay the $19 billion. But I said, it makes complete sense to me. You see why? Makes no revenues, no earnings, but what does it have? 450 million users. Even if you say 100 million of them are overlapping with Facebook, that's 350 million users. At $100 per user, what's WhatsApp worth for you? 35. They got a bargain at 19 billion. It sounds perverse, but it is the way it is. It's a pricing game. But here's what I think you have to watch out for. There will be a moment where markets will shift from users to revenue. I call these bar mitzvah moments. You ever been in a Jewish bar mitzvahs when Jewish kids grow up? There'll be the equivalent of social media company. There'll be a bar mitzvah moment where they have to grow up and they better be ready because that's the day they're going to say, our users went up 5% and somebody's going to say, where are your revenues? You've never asked me that before. What are you starting this revenue stuff for? I thought it was $100 per user from now to eternity. Not quite. So the good social media companies are the ones that are ready for the bar mitzvah moments. Facebook was. Twitter was not. That's why Costello lost his job, but I think Jack Dorsey is going to lose his job as well. It's a company that has 304 million users, but can't for the life of its own narrative come up with a way of figuring out what to do with those users. So those companies that you see out there that have all these high values, this is what's going to separate the winners from the losers. Those companies that think this is just a game to pick up more downloads, more users, are going to hit that bar mitzvah moment and they're not going to be ready. But the subset of companies where the managers have these parallel paths going, I'm not saying you should go out and buy users, but you have to start thinking about how do I monetize these users? How do I get those profits? You have to do this now. You can't run a field of dreams company. Field of dreams? If you build it, they will come. A lot of companies, the argument is, if I build the users, it'll come. I don't know what it is, but it'll come. You can't wait for the users to be built up. You have to start thinking about this early. So, don't force it. Think about what market metric and see if you can use it. It's not that complicated as long as you keep your focus. And here's my problem with bankers. If you're a banker, don't take this personally, take it personally, I don't care. What's a banker's job? To price companies or value companies? Right? You're a transactor. You have to get deals done. Let's be honest, your job is to price companies. So why the heck do you keep showing me these DCF models, which are reverse engineered to give you the price that you came up with in the first 5 minutes? You decide 6 times that sounds good. Now, how do I create a DCF model that, why are you wasting my time and your time going through this charade of making it look like you do valuation? You know what? Because I think we've created this stigma to being a trader. We're all supposed to be Warren Buffetts. We all buy things and we hold for perpetuities. Smart people are not supposed to do pricing. I'm sure there are people here who look at charts, but you do it under your table or you go to the restaurant. Because if anybody saw you looking at a chart and looking at technical indicators, and look at that guy, he's charting. That's almost like putting a scarlet letter on your back saying, this guy can't be in our group, he's not pricing. There's nothing wrong with looking at charts. Because what charts designed to do? Detect shifts in mood and momentum, and that's how you make money in pricing. And that's what I mean about playing the game you came to play. If you came to play the pricing game, don't bring out the discounted cash flow valuation. Wrong tool for this game. Bring out multiples, bring out comparables, bring out charts. I understand. If you came to play the value game, don't let the market price feed back into your value. In other words, you buy a stock because it's cheap at 25. The stock goes to 15. Don't revisit your valuation and push your valuation down because the market went down. Because if you do that, you're really letting the pricing game drive your value. And to play the value game, you have to have faith. Faith in what? Faith that you have an estimate of value that you're willing to live with. Not that it's right. And faith that the market price will adjust to that value. You know how difficult it is to maintain that faith? I would love to claim that I've always had that faith. I've been tested dozens of times over the last 25 years. And I've been sorely tempted to go over to the dark side. I've kind of held on, but it's often by the skin of my teeth where somebody says, you know what, this value thing is not working for me. I'll never mention it because I'm beneath the glass. I'm going to go to the pricing side. Those guys seem to have all the fun. But we have to decide what works for each of us. So if you decide the trading game is what works for you, play it well. If you decide the value game is what works for you, play it well. Just don't play the other game. The game you didn't come to play. And finally, I hate to break this to you, but you might already know this. This is a game where luck is the dominant paradigm. It's what separates success from failure. We like to think it's great valuation skills, great trading skills. If you're lucky, you can do some really screwy things and get away with it. If you're not, you can do everything right and have nothing to show. But what about those the smart money? You know what? I've been on a search for the smart money guy. If I ever find him, I'll let you know. The only smart money I found is the people who actually lose money for others but still get paid for losing money. That's the only smart thing that I know about smart money. But luck is something we hate to again think of as something that drives success, but it is a big factor. And if you think groups of investors out there are somehow special, I'll remind you that the alpha for hedge funds collectively has been negative for the last 3 years. We know that alphas for mutual funds have turned negative for the last 25 years. The alphas for hedge funds collectively. So collectively, what do hedge funds do? Take 2% of my money up front, take 20% of my profits to deliver 1.5% less than I could have made, not invest in the hedge fund. Go figure. I mean, my mind gets tired just thinking about this process. So, you're wishing for something, wish it to be luck. It was brought home to me by my mother-in-law when she came to visit in early 2000. My mother-in-law became an avid investor in the 1990s, which to me should have been a sign that the market was stopping off. Right? Put up a big sign in your house, mother-in-law avid investor, get out of the market right now. So she came to visit in early 2000. She drove us crazy. She'd wake up at 8 o'clock, she'd turn on CNBC, she'd watch it all day. She made it a spectator sport. Every time one of the stocks would go in the ticker, she'd cheer it on. Go Cisco, go! If it went up a quarter, look at all my cheering that did it. And all day long, that's all she did was talk about what was in her portfolio, what was out of her portfolio, what she wished was in it. And I had to act like I was listening. That's what son-in-laws do. And then she let it slip that she owned Qualcomm, one of the great stocks of 99, up 600%. I was really impressed. I said, Judy, how do you pick Qualcomm? I knew the minute I asked this question I shouldn't have, but she told me. She said she picked Qualcomm because it owned MCI. I said, that's not Qualcomm, that's WorldCom. She says, Qualcomm, WorldCom, what's the difference? If you really meant to buy the company that owns MCI, you've lost 40%, so you buy some other company that rhymes with it, you make 600%. She wasn't in the least bit faced by this. I was afraid to ask her after that why she owned Cisco. Afraid the answer might be, I really like their vegetable oil, which is Crisco, so I didn't make that, which is Crisco. Who knows what drove that particular decision? But I did try a strategy out after she left. I picked stocks and just pick one that rhymed with it. But I made a lot of money. It's intrinsic value stuff. My next book would have been the rhyming stock strategy. Just didn't work. So, if you can get lucky, everything else is going to fall through. So this notion that somehow there are people out there who are far smarter than everybody else, who beat the market consistently, exists only in the minds of conspiracy theorists. Collectively, you look at almost every group of professional investors. Collectively. And this is why I think financial services as a business is ripe for disruption. Right? Because collectively it's a huge business. Collectively it's a money drain. So you think about businesses that deserve to be disrupted, you're it. So you're already seeing the first round of that coming from Silicon Valley, right? Head of front, all these financial apps saying, hey, why are you paying these guys $220? Just pay me $200 a year. You know what protects you? Inertia. Inertia in the sense people are used to managing money the way they are. They want that psychological counseling of, hey, you were my private wealth manager. I know you screw up all the time, but you're such a nice guy. And you make me feel so much better after I've lost money. Don't let go of that. That psychological counseling might be all that stands between you and the abyss. Okay? But it's coming. It's going to be here sooner rather than later. Collectively, that's what the business seems to be asking. So I'm going to leave you with one of my scenes from one of my favorite movies, The Wizard of Oz. How many of you have seen that movie? And you have to see the movie. I'll kind of give you the synopsis of the story. It's a girl called Dorothy who lives in Kansas, who gets sucked up by a tornado and dumped into Oz. I don't make up this stuff. This is what the story says. She lands in Oz. She lands on top of a witch and kills the witch. So she's facing homicide charges, whatever. And she wants to go back to Kansas. Don't ask me why. I stayed in Oz, but she wants to go back to Kansas. She asks these little munchkins, I want to get back to Kansas. How do I get there? They say, follow the yellow brick road. The Wizard of Oz. He has the answers to all the questions. The whole movie is about Dorothy getting to Oz so she can ask the wizard for how to get back to Kansas. Along the way, she collects this motley crew. Scarecrow, the Tin Man, they all want something. And they're all told, get to the Wizard of Oz. He knows everything. He has the answer to every problem. They finally get to Oz, and this is the climactic moment in the movie. Each of them tells a wizard what they need, and the wizard says, come back tomorrow. It's like a government office. Why? And then this curtain falls, and it turns out that there's no Wizard of Oz. There's a little guy behind pulling strings. It's got to do with valuation and finance. Here's what happened in the course of the movie. In that journey, getting to the wizard, along the yellow brick road, each of them got what they need. They didn't need the Wizard of Oz. And I have the same suggestion and valuation. I get emails from people thinking I have some crystal ball I can look at. What effective tax rate should I look at Venezuela? How the heck would I know? But they think there's somebody who has the answers to every big valuation question. You learn valuation. The journey is where you learn the process. By valuing companies is how you learn to do valuation. Valuation is a craft. It's not a science, it's not an art, it's not some magic, it's a craft. You perfect a craft by doing it. So my suggestion to you is if you're interested in the value, if you want to play the pricing game, I don't know what to tell you, so go play that game. I have no idea how to play the game. But if you want to play the value game, the way you get good at it is by constantly revisiting the game, valuing more companies. That's about it. So if you have any questions, I'll be glad to answer them.
IPO, which came in Reliance Power. Did you ever made an attempt to value that company?
Can I say something about, I'll say it anyway, so I don't know why I'm asking this question. I would never buy a Reliance. I just don't feel comfortable with the corporate governance of that company to trust I've always had this view that if you want my money, then I want you to want my input as well. If I buy a share in a company, I want to share ownership in the company. I've never felt that with the Reliance company. And I don't know enough about the company yet. So my answer is it's a long no. It's got nothing to do with value versus price, whether I think it's cheap or expensive. But I don't feel comfortable buying a share in a company where I don't get a say in how the company is run. And I think that in general, family group companies, the way I describe it, it's like getting married. And the day after you get married, your entire set of in-laws move into the bedroom with you. Now, I like my spouse, but I don't want all my in-laws in the bedroom with me. But that's basically, I buy want to buy Tata Motors? I want to buy Tata Motors, not Tata Steel and Tata Chemicals and TCS. But guess what? I get all of them as part of the package. Stop giving me package deals. Let me buy the company I want to buy. And my problem with family group companies in general is I get these packages and I have no idea where the package ends and where the company begins. And I'm too tired to even figure out. Because it's like essentially the accountant holding up a brown paper bag with a cross-holding saying, trust me, it's worth 100 million. How do I know? Can I look at the bag? No, no. 100 million. Take it or leave it. I'm not willing to take that. So I generally steer away from companies with 30% of the value of the company comes from cross-holdings I can't even see. That there are other companies that might be private, might be held in ways I can't even get to the numbers. And that makes me incredibly uncomfortable. So that's a generic kind of cutoff that I use for company investing, that I want to invest in companies I understand, I can value and I can attach a number to. But that's because I play the value game. If you play the pricing game, Reliance Power might be a great way to make money. If you buy it at 50, sell it at 60. Buy it at 60, sell it at 75. Game doesn't work for me. I've got to play the game I can't do that. Any questions? Yes. Go ahead. I'll repeat the question. Don't worry. You don't have to get in the mic. Go ahead.
So how do you quantify competitive advantage? The DCF model assumes that like all companies exist for perpetuity, but capitalism only allows companies to have competitive advantage to do so.
And tell me why a DCF model. The question was, first, how do you show competitive advantage? But there was a second part, which is the DCF model assumes things last in perpetuity. Why in the DCF model is it required to do that? Right? You get to year 10, you have a choice. If you want to shut the company down, you can put in a liquidation value. DCFs are agnostic about perpetuities. We choose to use perpetuities as a convenience mechanism. If you gave me a royalty trust, you know how royalty trusts work, which is you have an oil royalty trust, you basically get dividends for 15 years and then the whole business shuts down. I'm not using a perpetuity there. It doesn't make sense. You give me Coca-Cola, I'm going to use a perpetuity because at the end of 10 years there's a going business or a going concern that's, and I get that choice. So there's nothing in DCF. We have all these misconceptions about what DCF requires you to do. Things like, you always have to forecast 10 years of cash flow. Who comes up with this stuff? You don't have to forecast a single year of cash flows if your company is already a mature company. You can do it in one equation. And you don't have to assume a perpetuity. On the question of competitive advantages, what's the essence of competitive advantage? That you can earn more than your cost of capital, right? The way you capture it is by allowing companies to earn a return on capital well above their cost of capital. And I think we're far too easy on companies on that dimension. At the start of every year, I take all publicly traded companies globally. There are about 41,500. I estimate the return on capital and cost of capital for every company. It's a big Excel spreadsheet. I have to make some little contortions to get that. The return on capital and cost of capital for every company. And then I do a comparison return on capital and cost of capital. You know the question I'm trying to answer? Across the world, what percent of companies earn more than their cost of capital? Across the world, what percent of companies earn less than the cost of capital? Give me a guess. What percent of companies do you think earn more than their cost of capital? It's a little higher than that. 5% is really pessimistic. It's about 20% of companies earn more than their cost of capital. Those are our great companies. 54% of companies earn below their cost of capital. That's a scary thought. And here's the even scarier thought. 35% of those companies have done this every year for the last 10 years. I actually put a post on this. Why do companies in bad businesses keep trying to grow? There are lots of bad businesses. In fact, I listed my 10 worst businesses in the world. And there is the auto business. I don't know why I should lend to that business. It's a horrific business. It's a horrific business that collectively has a tough time as a business making its cost of capital. In fact, Sergio Marchionne, who's the CEO of Fiat, has been open about this. One of the few CEOs in a business actually come out and say, we're in a bad business, we need to change this. We're being insane. We're investing huge amounts of money, earning less than the cost of capital, and we're not changing. You know what the reaction of the other CEOs was? I don't hear this, I don't hear this, I don't hear this. So there are lots of companies that earn less than the cost of capital. The 20% are the exceptions. So when you attach a premium to a company, you have to decide whether your company is going to be one of those exceptions. And for you to be the exception, that competitive advantage has to be both strong and sustainable. Right? It's got to be something that you can hold on to. And that's another question to ask about these young, rising social media companies is, how do you deal with success? Not how do you deal with failure? We know what to do with that, right? There's going to be nothing there. But what are you going to do if you succeed next year and you start selling a lot? You know why I asked the question? Because if you start to succeed, what's going to happen? Spotify starts to make a lot of money because people are paying $9.95 a month. What's Apple thinking about doing? It's not even thinking about it. About a month, you're going to see Apple Music. And it's going to be set at what, $5.95 a month? You say, but Apple's going to lose money. You've got $202 billion in cash. You can give the stuff away for free. Wipe out Spotify in about 2 years and then start to raise prices. So that's the question I ask you. What are you putting in place that when the Apples or Googles or whatever the other companies that comes in with deep pockets, what do you have in place that's going to keep the competition up? And so we'll think about it once we get there. It's going to be too late. You have to start doing this while you're building up the business and start putting those competitive pieces in place. And that again is something that's going to separate the successful players in this young space from the unsuccessful players. Any other questions? Yes?
So one of the things you mentioned was dichotomy between price game and the value game.
Yeah.
Yeah, but my question is that valuation exercise itself is riddled with information asymmetry. So we don't know what we don't know. So pricing is basically a signal.
Keep going.
Yeah. So, but having said that, price itself is a signal which tells us that maybe we don't know something. Don't you see there's a potential for both of them merging here? So basically, price going up.
If you're doing a valuation, can you learn anything by watching the price?
Yes, because there might be something which we don't know.
Well, you're assuming that what you don't know, somebody else knows.
Yes.
With companies like Twitter, you know what? What you don't know, nobody knows. That's a reality. Dick Costolo doesn't know. Mark Zuckerberg doesn't know what the online... So in a sense, it's not like there's a secret information base where if you go to it, you know what the market share of every social media company is. So I think with established companies, I think what you say is true. For young companies, I think what you don't know is just not know. It's not that if you tried harder, you would find out. It's just not know. And that's why I've said you can't let hubris get in the way, because the way you find these things out is over time. And as you find those things out, guess what you have to do? You have to adjust your narrative and your valuation to reflect it. So to me, that's the essence. It's not what you learn from the pricing process, but in how you extract information from what's coming out and looking at how it affects your narrative. Because the pricing is going to be a distraction. They're going to overreact to strange things. They're going to react to Twitter posts about people not being in line outside the Beijing store. You want to kind of look past that. What information you're getting that changes you. Make it about narrative. If your narrative for a company changes, the value will change. For Facebook, for instance, when I valued Facebook the first time around, I got $28 per share. Last August, I revalued Facebook, and I said the 3 words that all of us hate to say. I was wrong. I was wrong because I viewed Facebook as a Google wannabe in my original narrative. And given the way Facebook has acted and behaved over the last 2 years, I think Facebook is going to be bigger than Google. So I said, I've got to change the narrative to reflect that. And I think they're going to make a lot more revenue and a lot more money than I thought. The value that I gave for Facebook with the new narrative was $65. And I got this whole lot of blowback from intrinsic value purists. Said, then your intrinsic value must be wrong. Intrinsic values never change. This is the problem. You learn all your intrinsic valuation from Ben Graham's security analysis. And use a dividend discount model. And you value railroad over and over again. Of course things are not going to change. But if you're valuing a young growth company, guess what? Intrinsic value can and should change as the narrative changes. Facebook, the narrative changed. But what? Decision didn't change. When I valued at 28, the stock was at 38. When I valued at 65, the stock was at 90. No, it was at 73. And I revalued it yesterday. It was 71. It was my new intrinsic value. The price is at 95. What does it all mean? Well, I'll be change. Sooner or later, Facebook is going to be in my portfolio, just not right now. So I think that's what I mean about narrative shifts. Is when I look at these young growth companies, I'm looking for things that change my story. It could be small things, it could be big things, because if my story doesn't change, my value is not going to change very much. But that's why I think we all have to work on what our weak link is. My weak link is I'm a natural number cruncher. I want to go to the numbers, I want to start an Excel spreadsheet. And I have to consciously stop myself and make myself tell a story. Even if it's just me. Kind of boring to listen to myself. I said, tell me the story and then we'll put the numbers in. Because that's what kind of builds up that story. I think I'm getting better, but it might be pure delusion. But I can tell stories a little better. I'm almost like a strategy guy. I can tell really good stories. But not quite, because I can also put the numbers in the story. It took me a while to get to where I am. I have to keep working at it because I know it will always be my weaker link. So whatever your strong point is, if it's numbers, work on stories. If it's stories, work on numbers. Because neither side starts off in an advantage here. Each of us has a blind spot. And you got to get less blind about that spot. Any other questions? Yes? Should the value of a company change depending on which currency you do the valuation? What does common sense tell us? And if it does, we're in trouble, right? Can you imagine my equity research report going out? I've done 5 valuations of the company in 5 different currencies. In 3 I got buys, 2 I got sells. Doesn't work. The only scenario where it might work is if I have an ADR list that doesn't quite translate. But if I have the same stock and I value it in 5 different currencies, how can that be? If I value my company in rupees, I'll get a much higher discount rate. True. But why is your discount rate higher when you value a company in Indian rupees than US dollars? It's inflation. You're saying it's not, it's country risk. No. Country risk has to show up. Whether you do things in dollars or rupees, it's inflation. If you have a high inflation currency, you're going to have a high discount rate. This is awful. That's a bad news. And you get to the cash flows, and you do everything in Indian rupees. So guess what inflation you should be building into your cash flows? The much higher inflation. What one hand gives away, the other hand will give you back. It'll all even out. If you do things right, that's a big if. Your valuation should be currency invariant. You've got to make a decision as to whether you're going to value it in rupees or in dollars, but it doesn't matter, right? It doesn't matter. I can take a company with everything in rupees and convert it to dollars. Currencies are a measurement mechanism. By switching currencies, in fact, in Latin America, this used to drive me crazy. They have an Argentine company. An analyst would say, I've dollarized the company. So what the heck does that mean? He said, I made it safe. I said, really? That's all you need to do is take the pesos, convert them to dollars? That was all you needed. We just take Excel spreadsheets, we make risky companies and safe companies. So I think that if you have country effects, it's going to show up in your dollar cost of capital, it's going to show up in your rupee cost of capital. Where you operate, this is the point I was making from the bulk of today, is we have this a lot of valuation practices that I think are bad but get entrenched. For instance, practice of using an Indian government bond rate as a risk-free rate in rupees is, I think, flawed. Why? Because I